We just had the biggest intraday drop in silver's history. In a short period of time, silver fell roughly 40% from the high to the low. That scares anyone. And a lot of people now want to know, is this the bottom? Will it drop more? If I buy now, will I nail it? But slow down. First, we need to understand, what caused this drop? Does this change the silver thesis? What can we realistically expect from here? And most importantly, what did I do with my own money? Stay with me until the end, because I'm going to walk through all of it calmly. No hysteria, no nonsense. If you're new here, nice to meet you. My name is Ken AG. If you like the content, subscribe and turn on notifications. And if you have questions, leave a comment. I read them all and reply whenever I can. Before we continue, the quick and necessary disclaimer. This is educational content, not financial advice. Everyone has their own situation, risk tolerance, and time horizon. Now let's get to what matters. Friday already started ugly. Silver opened down around 13%. Up to that point, fine. It had basically gone straight up. A correction was inevitable. But what nobody expected, by the end of the day, the drop reached about 35%. Some platforms saw wicks down to 40% from the highs. That's insane. The biggest intraday drop in history. A statistical 10 sigma event. Something that, according to some studies, happens once every 5.25 septillion years. Let me put that in perspective. The universe is estimated to be about 14 billion years old. A septillion is 1 followed by 24 zeros. This event is so statistically unlikely that you would need trillions of universes over trillions of lifetimes to expect to see it once. In other words, nobody could have predicted this. Even the most sophisticated risk models, the ones used by major banks and hedge funds, don't account for 10 sigma events. They assume markets follow normal distributions, where moves beyond 5 or 6 sigma are essentially impossible. But markets aren't normal distributions. They have fat tails. Extreme events happen more often than the math suggests. And when they happen, they're devastating for anyone who's over-leveraged. Even so, it's important to put it in context. Silver is still positive year to date. The SLV ETF is still up around 15% on the year. Was it a shock? Yes. Did it change the game? Not yet. Because to understand whether this is the bottom or whether we're heading lower, you need to understand we know this drop wasn't caused by just one factor. It was an explosive combination of 5 major forces that hit simultaneously. Let me walk through each one, because understanding the causes helps you understand what happens next. First, massive profit-taking. Think about the setup going into Friday. Silver had run from around $78 in December to $122 in late January. That's a 56% move in roughly 6 weeks. Anyone who was long from the 80s or 90s was sitting on enormous unrealized gains, 50, 60, 70% profits. And when you have that much profit on the table, the temptation to take some off is huge. Now, add the fact that a lot of traders were positioned heavily on the same side. Long silver, long gold, short dollar. That's the trade everyone was doing. It was crowded. And crowded trades are fragile. Because when they start to unwind, everyone heads for the exit at the same time. You get herd behavior, panic, stampede. That creates a chain reaction. Selling begets more selling. Stops trigger more stops. And before you know it, you're down 35%. Second, a shift in U.S. rate expectations. This one caught a lot of people off guard. Until last week, the market was expecting rate cuts. The narrative was that inflation was under control, growth was slowing, and the Fed would have to ease. That's bullish for metals. Lower rates mean lower opportunity cost for holding non-yielding assets like gold and silver. And it means a weaker dollar, which is also bullish for commodities. But with the nomination of Kevin Warsh to the Fed, The expectation shifted toward a tougher stance. Warsh is known as a hawk. He's focused on inflation control. He believes in keeping rates higher for longer. And when the market started pricing in that shift, when traders realized rates might not come down as quickly as expected, that pressured metals. Because higher rates make the dollar more attractive. They increase the opportunity cost of holding silver. And they signal that the Fed is willing to tolerate economic pain to control inflation. Fourth, CME margin hikes. This is crucial, and it's something a lot of retail traders don't pay attention to. Throughout January, CME, the exchange where silver futures trade, repeatedly increased margin requirements. What does that do? It forces leveraged traders out. If you're holding a futures position on margin, and the exchange raises the margin requirement, you have two choices. Either post more cash or close the position. Most traders can't post more cash. They're already leveraged. So they close, they sell, and when thousands of traders are forced to sell at the same time, it creates artificial pressure. This isn't natural price discovery. This is forced liquidation, and it makes one thing very clear. This was paper flow, not physical metal. Physical buyers weren't selling. Industrial users weren't dumping inventory. This was derivatives, futures, leverage, margin calls, and fifth, it was the last trading day of the month. End-of-month positioning is always volatile. Funds rebalance, portfolios get adjusted, books get closed for monthly reporting, and that creates forced flows. Combined with everything else, with the margin hikes, with the rate shift, with the dollar strength, the timing was perfect for a massive shakeout. It was a perfect storm. Now here's the most important point. Nothing changed in the fundamentals. Nothing. Physical silver is still a historic hedge against inflation, a store of value for thousands of years. And beyond that, demand is still strong. Solar panels need silver. Electronics need silver. Mirrors, jewelry, industry, all of it still requires silver. And the technology doesn't change because futures traders panic. A solar panel still needs 20 grams of silver, whether the price is 120 or 75. Supply is still limited. There's real risk of a supply shock. Mine production is relatively flat. Most silver comes as a byproduct of copper, lead, and zinc mining. You can't just ramp up silver production quickly, and inventories have been draining for years. This is a classic commodity setup. Structural deficit, growing demand, constrained supply, declining inventories. That doesn't change because of a 10 sigma price event. And the gold-silver ratio is still absurd. Historically, the ratio has been 10 to 1, 15 to 1. That's the natural ratio based on relative scarcity and industrial utility. Today, the ratio is around 57 to 1. That's extremely bullish for silver. It means silver is undervalued relative to gold by a factor of 3 to 4. And when ratios get that extreme, they revert. Not smoothly, not gradually, but violently. So does this change the thesis? No. But it does change the psychology. And psychology matters in the short term. Let me explain the dynamic we're likely to see. A long-term investor doesn't try to guess the perfect bottom. They understand zones, processes, and human behavior. When the market panics, opportunities appear. Not make money tomorrow opportunities, but opportunities to buy something good at a psychological discount. Right now, there's a certain group of people buying the dip, thinking, wow, I was willing to buy silver at $120 an ounce. Now I can buy it at 75, maybe 80. That makes sense to me. So there's some suppressed demand that can help keep price supported. These are the value buyers, the patient capital, the people who understand fundamentals and can tolerate volatility. But the reason it may not instantly rip back to all-time highs is psychology. Think about the volume we saw at $120, $115 an ounce. Those buyers are panicking. They bought, probably with leverage, and then a day or two later, watched the position drop 40%. That's terrifying. If you bought at 115 with 2 times leverage, you're now down 80%. You might be facing a margin call. You might be forced to liquidate at the worst possible price. Let me paint a specific picture of what these buyers are experiencing. Imagine you saw silver at 120. Everyone you follow on social media is saying it's going to 200. The momentum is incredible. FOMO kicks in. You don't want to miss it, so you buy. Maybe you put in $10,000. Maybe you use margin to amplify it to $20,000 in exposure. You're excited. This is it. Then Friday happens. You wake up and silver is down 13%. Okay, you think, it's just a pullback. I'll hold. But it keeps falling. 95, 85, 75. Now your 10,000 is worth 3,000. If you used leverage, you might be completely wiped out. You're staring at your screen in disbelief. How did this happen? Should I sell? Should I hold? Every minute you wait, it drops more. The panic is overwhelming. Finally, you can't take it anymore. You sell at 78. You lock in a massive loss. You swear off silver forever. You tell yourself, I should have known better. It was too good to be true. But here's what you don't realize. You just became the liquidity. You just transferred your wealth to someone who understands the difference between price and value. Someone who knows that 40% drops in bull markets are normal. Someone who's willing to buy when you're forced to sell. So what tends to happen is this. As new buyers push price up, you also get sellers who just want to get back to break even. Once they recover their initial investment, they say, you know what? That was way too scary. I'm out. I got my money back. I'm moving on. Those are the two forces battling. New buyers looking for value, old buyers looking for exits. And that creates resistance. It creates a range. It creates choppy consolidation. From a technical analyst perspective, I do think we see a rebound from these levels. I think we could move back into the 90s, maybe even push toward 100 again in the near future. Why? Because the fundamental buyers are still there. The industrial demand is still there. The deficit is still there. And 75 to 80 is such a deep discount that it attracts capital. But I also recognize that we could see more downside first. If we get another wave of forced selling, if there's a major fund that blows up, if margin requirements get raised again, we could test lower levels. 65, 60, maybe even 50. And that's not bearish long term. That's just market mechanics playing out. Over-leveraged positions getting flushed. Weak hands getting shaken out. The market finding the level where real buyers overwhelm forced sellers. Let me give you historical context, because this has happened before. In 2008, silver crashed from $21 to $9. That's a 57% decline. Everyone said silver was dead. Industrial demand was collapsing. The recession was going to kill metals. But by 2011, silver hit $49. Anyone who bought at 9, at 10, at 12 made 4, 5, 6 times their money. In 2020, during COVID, silver dropped from 18 to 12 in 2 weeks. 33% decline. People panicked. The world was ending. But by August, silver was at 30. If you bought at 12, you more than doubled your money in 6 months. The pattern is always the same. Panic creates opportunity. Forced selling creates value. And patient buyers get rewarded. But let me go deeper into history, because the lessons are even more powerful when you look at full bull market cycles. In the 1970s, gold and silver had one of the greatest bull runs in history. Gold went from $35 to $850. Silver went from $150 to $50. But those moves weren't linear. They were interrupted by brutal corrections that tested everyone's conviction. In 1974, gold crashed from $195 to $103. That's a 47% drop. The exact same magnitude as what we just saw in silver. People were convinced the bull was over. Gold is going back to 35. The government will reimpose controls. It's done. But those who sold at 103 missed the move to 850. They gave up right before the biggest part of the bull market. In 1975, silver dropped from $5.20 to $3.80. That's 27%. Not as dramatic as the gold move, but still enough to scare people. And again, those who sold missed silver going to 50 by 1980. The lesson is clear. Bull markets don't move in straight lines. They shake out weak hands repeatedly. And the biggest gains often come after the scariest corrections. Let's look at the 2000s precious metals bull market. Gold bottomed around $250 in 1999. By 2011, it hit $1,900. Silver bottomed around $4 in 2001. By 2011, it hit $49. But the path was violent. In 2008, when the financial crisis hit, gold dropped from $1,000 to $700. 30% correction. Silver dropped from 21 to 9. 57% correction. Just like what we're seeing now. The narrative at the time was deflation, credit collapse, deleveraging, cash is king, metals are going to zero. But what actually happened? The Fed panicked. They cut rates to zero. They launched quantitative easing. They printed trillions. And metals exploded. Gold went from 700 to 1900. Silver went from 9 to 49. If you bought in the panic, you made generational wealth. The difference between those who made money and those who didn't wasn't intelligence. It wasn't access to information. It was psychology. The people who sold at $700 gold or $9 silver couldn't handle the fear. They saw their positions down 30, 40, 50%, and they capitulated. But the people who held, who understood the thesis, who recognized that monetary policy would eventually respond, they were rewarded beyond their wildest dreams. So where do I think we go from here? Let me give you 3 scenarios with rough probabilities. But first, let me address the title of this video directly. Is $50 incoming? That question has 2 meanings. Does silver crash to $50? Or does it rally so hard that hitting 50 again on the way up becomes inevitable? Let me tackle the bearish case first. Could we see silver at $50? In an extreme forced liquidation, if a major fund blows up, if there's a cascading margin call crisis, technically yes, we could see a wick down to 50 or even lower. But I think the probability is very low, less than 5%. Here's why. At $50, you're back to where silver was in early December. The entire January rally gets erased. At that level, the fundamental buyers would step in massively. Think about what $50 silver means. It means a gold-silver ratio of over 100 to 1 if gold stays at 5,000. That's absurd. It's never been that extreme. Even in the worst crashes, the ratio rarely exceeds 80. At 100 to 1, the arbitrage becomes so compelling that funds would buy silver and hedge with gold. The trade would be too obvious to ignore. More importantly, at $50, physical buyers would flood the market. Asian buyers who were paying 120, 110 in January would see 50 as a generational gift. Mints would get overwhelmed with orders. Refiners would max out capacity. The physical demand would create a floor that paper sellers couldn't penetrate. So while I can't rule out a spike to 50 in some black swan scenario, I think it's very unlikely. And if it happens, it would be extremely brief. Now let's talk about the bullish case. $50 on the way up. If silver rallies back above 100, if we retest the highs, if we break out to new all-time highs, then yes, we'll obviously pass through 50 again. And if the bull thesis is correct, if we're in a multi-year secular bull market driven by supply deficits and monetary instability, then 150, 200, even 300 becomes possible over time. At those prices, hitting 50 would just be a footnote, a level we passed through and never looked back. Here's what that path might look like. We bottom somewhere between 70 and 90. We consolidate for weeks or months. Fear subsides. Weak hands are flushed. Physical demand stays strong. Then something catalyzes the next leg. Maybe the Fed pivots to cuts. Maybe there's a geopolitical shock. Maybe COMEX inventories hit critical lows. Whatever the trigger, price breaks out. We reclaim 100, then 120. Then we're making new highs. 140, 160, 200. In that scenario, $50 is just a distant memory. Which path is more likely? I lean toward the bullish case, not because I'm permabull, but because the fundamentals support it. The deficit is real, the demand is real, the supply constraints are real, and the monetary backdrop, unlimited government spending, currency debasement, that supports hard assets. So while I can't rule out more near-term pain, I think the long-term trajectory is significantly higher. Scenario 1, V-shaped recovery, probability around 40%. We've flushed out the weak hands. The forced selling is done. Physical buyers step in aggressively. We rally back above 90 within days, above 100 within weeks. This happens if the fundamental buyers are as strong as I think they are, if Asia keeps accumulating, if industrial demand stays robust. Scenario 2, choppy consolidation. Probability around 45%. We range between 70 and 90 for several weeks. New buyers battle old sellers. We form a base. Volatility compresses. And eventually we break higher when everyone's exhausted and positioned wrong. This is actually the most likely outcome because it's how markets usually work after extreme moves. They don't immediately reverse, they consolidate. Scenario 3, more pain first, probability around 15%. Another leg down, maybe to 60, maybe to 50, driven by forced liquidations or some external shock. But even in this scenario, I'd view it as a gift, because if we hit 50 with the fundamentals still intact, the value proposition becomes overwhelming. You'd see massive physical buying, mints would get flooded with orders, and the bounce would be explosive. Now let me tell you what I did with my own money. I'm not giving advice, I'm sharing transparency for subscribers who asked. I held my physical. I didn't sell an ounce. Physical silver is not a trade for me. It's wealth preservation. I bought it understanding volatility would happen. A 40% drop doesn't change why I hold physical. On the trading side, I added exposure. Not all at once, but I scaled in. I bought some at 85, I bought more at 78. If it goes to 65, I'll buy again, because I believe in the fundamental thesis and I can stomach the volatility. But here's the critical point. I'm not using leverage. I'm not trying to time the exact bottom. I'm not betting the farm on a bounce tomorrow. I'm positioning for a long-term thesis with capital I can hold for years if needed. That's the difference between investing and gambling. Gamblers need to be right immediately. Investors can afford to be early and wait for the market to come to them. Patience, the rarest asset of all. If there's one thing that separates people who build wealth from people who run in circles, it's this: patience. It took me a long time to learn that. When I tried to win fast, I lost fast. When I accepted waiting, results came. Markets are machines that transfer money from the impatient to the patient, from the emotional to the rational, from the leveraged to the unleveraged. What I do in moments like this, I don't panic. I don't try to predict the next move. I don't make emotional decisions. I observe. I watch how the market reacts. I watch how the narratives change. I watch who's being forced out. And most importantly, I remember why I'm in this asset. If the reason is structural, a drop doesn't change that. If the reason was emotion, then price exposes the mistake. So, let me give you practical guidance. What should you watch this week? What are the signals that tell you whether we've bottomed or whether more pain is coming? First, watch volume. If we get a high volume bounce, if we see massive buying coming in at these levels, that's a sign the bottom is in. Big volume at the low indicates capitulation. All the weak hands sold. Now strong hands are accumulating. Second, watch the dollar. If DXY starts rolling over, if it tops out and reverses, that removes one of the headwinds for metals. Dollar weakness is metal strength. It's a fundamental relationship. If the dollar breaks down, metals catch a bid. Third, watch for margin requirement changes. If CME stops raising margins, if they hold steady or even reduce them, that removes the forced selling pressure. It allows leveraged traders to hold positions without constant liquidation. Fourth, watch physical demand indicators. Mint sales, dealer premiums, Shanghai prices. If physical premiums stay elevated, if mints can't keep up with orders, if Shanghai continues trading at a premium to COMEX, that confirms the fundamental thesis. That tells you paper crashed, but physical demand is strong. And fifth, watch sentiment. When everyone's terrified, when capitulation is obvious, when people are swearing off silver forever, that's usually the bottom. Not the exact tick, but close enough. Because markets bottom on maximum pessimism. They top on maximum optimism. Right now we're seeing fear. Not quite capitulation yet, but getting close. So I want to end this video with one simple question. Are you looking at silver as a price or as a process? If you only look at the price, this drop is terrifying. If you look at the process, it's instructive. It's not comfortable. It never is. But almost no great opportunity looks great in the moment it shows up. If you're thinking about physical silver for the long run, learn to respect time, ignore noise, and use other people's fear as information. If this video made sense to you, subscribe. Leave a comment telling me how you're looking at this moment. Are you buying? Are you waiting? Are you out? I read them all. Thanks for watching, and I'll see you in the next video.